Hey guys, this is Andre from Wealth Neighbor. Hope you are all doing well. So this is our third and final video of the Dealing with Risk series. As you remember, in the first video, we covered a brief introduction about financial risk and we made an analogy with surfing. And in the second video, we made some other analogies about how risk affects common events in our regular life. And in this final video, we will sum it up and add some recommendations about how to build a balanced portfolio and try to deal with the market risk as best as we can. Take a minute to read the disclaimer, and if you agree with all the terms, let's go. So these are the topics we'll cover in this video. First, there is no free lunch. This is a very common sentence in the financial markets. Don't expect things to come for free, and more importantly, if something seems too good to be true, it probably is, so don't take the bait. And diversification, what is this about? And this is the closest thing we can get to a free lunch in the financial market. And some variables that affect money in the future, money with time, and what should we consider before we actually start investing. And these variables also have some say in risk, in how much risk we need and how much risk we should take based on our objectives. And finally, we'll wrap the video up with some simple strategies we can use to build our investing portfolio. So there is no free lunch. Remember from the first video that risk and potential returns go hand in hand. So usually when there is this very attractive investment, it will come with a lot of risk. And remember that risk in the financial markets is related to the volatility. So the odds that the value you have invested will go up and down through time, but ultimately we want it to increase. We want our investment value to increase over time, but volatility will make it go up and down, up and down. And this is related to risk. There is this black swan theory. It was made by this guy called Nassim Nicholas Taleb, and he put it up on his book called The Black Swan: The Impact of the Highly Improbable. So basically, what does black swan theory mean? So a little bit of history here, guys. Back in the days in Europe, I guess people were not used to see black swans at all. So they thought that there were only white swans. Only white swans existed in the world. But when European people went to Asia, they saw the first black swan, and it was a huge event for them because they thought that it didn't exist. So back in Europe at this time, a lot of people would bet all their life earnings. If you can find me a black swan, I will give you all the money I have, because they were pretty sure that there were no black swans. But then when someone actually found one, they thought that, yeah, black swans do exist. And it's proven, it's a fact, someone saw it. So what can we get from this theory? Improbable events can happen every now and then. The probability is not that high, but it's also not zero, so we can expect the unexpected. For example, who could have foreseen the 1929 market crash? Who would have known that the stock prices would go so low in such a small time interval? In one day, the stock indexes would drop almost 20%. So this is huge and no one could have predicted it. But we know that there is a possibility, and this is what Nassim says in his book. the black swan theory. We should expect the unexpected. Even though the probability is very small, we should try to prepare for it and should be aware that it can happen. Something that derivates from Nassim's black swan theory is the fact that financial events don't usually follow the Gaussian distribution or normal distribution, but rather a fat tail distribution. What does this mean? So the Gaussian distribution is like a bell-shaped distribution. So it means that most of the events will happen with a high probability in the middle of the scale, and as the probability spreads out through the tails, the likeliness of such extreme events are lower and lower. But what we actually see when we analyze financial data from 20, 30, 40 years ago, we can see that those financial events, those stock market crashes, or other events that affect the global finance, such as wars, terrorism attempts, huge company mergings, all the stuff that affects the economy will happen, and the odds are not that small. And more important, when one event happens, it's very likely that another one will follow within the next 2 to 5 years. And if we base these facts in a normal distribution, the events would be spaced like 20 to 30 years from each other. They would never take place so close to each other. So this means that financial events do not follow a normal distribution. We should not rely on the regular statistics to estimate and forecast the financial events. Always be prepared to randomness. Always be prepared to a disaster or something very good happening in the markets. And always be aware that there is a possibility that something is going to happen and no one will be able to predict it. We saw in the previous slide that random events can happen and there is nothing we can do to forecast them. But what can we actually do to protect ourselves from them, at least in the financial sense? The thing we can do is diversify our investments. What does this mean? Basically, there are two kinds of financial risk. We can divide the financial risk in two categories, two broad categories. The first one we can call the systematic risk, which is the risk associated with the whole system, with the economy, the global economy in general. So say that there is a World War III and United States wipes out half of the planet. So this is like a huge disaster, and no matter what we have money invested in, this money will probably be gone and we'll be living in a crisis. So this is all systematic. This comes from the system and there is nothing we can do to avoid it. If such a catastrophic event happens, we might not even need money at all. Who knows? And the second category of risk is called a non-systematic risk, with the risk associated to particular branches of the economy. For example, a sector like the petrochemical sector or the textile sector, or even particular industries, for example, ExxonMobil or Amazon or eBay, Facebook, or GM and Volkswagen. So each kind of company, each kind of industry, and each kind of sector has this non-systematic risk associated to it. And by diversifying our portfolio, we are going to spread the non-systematic risk so that if something happens in the petrochemical sector, our stocks from the internet sector are more or less protected to this event that crashed stocks in the petrochemical sector, because they are not entirely correlated. Still, both prices will go down because of the systematic risk. I mean, something terrible happened in the petrochemical sector, so everyone is kind of afraid of putting their money in the market and buying stock. So we can expect an overall price drop, but definitely prices from stocks in the petrochemical sector will go down much more than the prices from the stocks in the internet sector. Keep in mind that investors are not rewarded for taking the non-systematic risk. So the difference between lending investment and an ownership investment is that when we take an ownership investment, such as when we buy stock, we are owning a piece of a company. So we are active participants in this company, okay? And at this moment, we will benefit from the company's profits and we will lose from the company's losses. Which means we are taking risk. But as investors, we are just rewarded for taking the systematic risk of investing in companies in general. We are not rewarded for investing all of our money in just internet stocks. Okay, we are not going to make more money if we just invest in eBay, Amazon, Google, and Facebook, and then there's an internet sector stock crash. It doesn't work like that. Therefore, in order to minimize the non-systematic risk and be actually rewarded for the systematic risk as investors in ownership investments, as investors in the stock market, we have to do our best to diversify our investments in different sectors. Actually, we can go even further. We can invest in foreign economies. We can invest in the United States, in Europe, in companies from different countries. We can also invest in both companies and in real estate. So we make sure we have a diversified portfolio and punctual economic events that affect the market negatively will just affect a percentage of our portfolio, while the rest of it will be protected or kind of protected. Now I will show you guys a few things we should consider before starting to invest, starting to build or investing portfolio. I want to show you this little formula here. This is the future value with compound interest formula. And what this formula tells us is that the future value of your investment, for example, equals the present value of your investment times 1 plus the annual return rate of said investment divided by the number of times that return rate is compounded through the year to the power of the amount of times the investment is compounded again times the number of years you keep your investment going. So from this formula we can tell that the future value of our investment will be affected by the current value, or how much we can save and how much we can invest. It will be affected by the return rate of our investment, and it will also be affected by the time we invest our money for. And taking into account these three variables, which one would you say is the easiest, is within our control? Well, in my opinion, I would say that the amount of money I can save and invest is the variable that is more within my control and the easier one to handle, because return rates, it comes back to what I said before. Right returns come with high risk, and the time. The sooner you start investing, the more money you have in the future. But you have to start. The sooner the better. So in my opinion, the variable I can control better now is the present value, or how much I invest on a regular basis. But if I could meet my younger self 15 years ago and leave him a message, I would say, dude, start investing your money now, because you have 15 years of compound interest to work with. So the easiest variable to handle would be the time, because we will have this compound interest working for us, working on our side, and this is very good. So the sooner you start investing, the better your options, because depending on the goal you have, how much money you need in the future, or how much money you want to have in the future, you can opt for low returns if you don't need that much. So you don't need to take a lot of risk. You can gauge, and you can know how much risk you need to take in order to reach your goals. So you won't take unnecessary risk, and this is very important. In later videos, we will come back to this formula and explore entering different amounts, different numbers, different present values and return rates and time, to see how these variables work together, and try to come up with some investment strategies that work for us. But for now, remember the three variables that will affect our future value, our money in the future, our investment: the return rate, the time we invest, and the amount we invest. Now I want to show you guys two simple strategies to build an investing portfolio. The first one is quite simple. You start with 50-50. 50 lending investments, which include bonds or certificate of deposits or money market funds, and 50% ownership investments, which include stocks and real estate, and maybe you want to invest in opening your own business. So your initial portfolio should be 50-50, and then according to the economic scenario, you can shift one side or the other from 25 to 75%, and of course the other side will balance automatically. The second portfolio building strategy is this. So we take 100, or maybe 110 if you want to be more aggressive, or 90 if you want to be more conservative. And then you take your current age. How old are you right now? And you subtract 100 from your current age. So in my case, I'm 30. 100 minus 30 equals 70. So I will put 70% of my portfolio on ownership investments, and the remainder 30% in lending investments. And every couple of years, every 5 years, that my market value changes, I will rebalance my portfolio according to my current age. Or if I'm following rule of thumb number 1, I will rebalance the portfolio according to the economic scenario. Remember that these two are very simple rules to start investing and start building a portfolio. Of course, you should research more, you should study more, and you should even consider hiring someone to help you build this portfolio, because after all, this is your money we are talking about, and this is your work and effort, and this is your future we are talking about. So we don't want to be so careless about that. Now finally, let's wrap the whole dealing with risk series up. So everything we learn from video 1 to this video. First thing, you do not have to adjust your portfolio every year. Actually, you should not do that at all unless you know very well what you're doing. So as I said before, try to adjust every 5 years or so, based on the strategy you're following or based on the recommendations of the manager you hired. But do not do it too often because it will incur a lot of expenses, a lot of costs, like transaction costs. So it's not a very good idea to keep mingling with your portfolio too often. Important, adjust your portfolio every time you start to feel uncomfortable about the amount of risk you're taking or about the amount of risk you need to take to reach your goals. So, for example, due to market value appreciation, maybe the stocks you bought 3 years ago are worth much more than they were before. And now your portfolio is like 80% stock market and 20% bonds. And this makes you very uncomfortable because of the volatility of the stock market. So you should consider selling maybe half or 33% of your stock portfolio and buying back new bonds or new debentures to rebalance your portfolio and make sure that you feel comfortable about it. Sleep at night without being worried about market crashes and the paths the economy is taking. It's impossible to predict the future. Remember, Black Swan theory. The unexpected can happen and will happen, and there is nothing we can do to predict it. But especially with stock market indexes and funds, we can check the previous performance and take a look at the previous trends, because this is most of the time the best tool we have to forecast future earnings. Every time we read about the characteristics of an investment or a fund, we'll see that they have this disclaimer. Past earnings are not expected to be future earnings as well. So what happens in the past might not happen in the future. And only because the investment has been doing really well for the past 3 years, it doesn't mean that it will still be doing well in 3 years from now. But the past is the best we can do, is the best information we can have to predict the future. And we have to use it wisely. First thing we learn in this video, there is no free lunch. High returns always come with high risk. What can we do to minimize the risk? Diversify our portfolio. Diversify it between different sectors, between local and foreign economies, between different kinds of investments and stock market and real estate. And keep your portfolio diversified so you're not 100% affected every time something bad happens in a given sector of the economy. Also, be aware that when it sounds too good to be true, it probably is not true. And do not believe in everything you hear out there. Do not believe in everything people say, because there are a lot of people after our money. They want to sell us bad investments just to get their share of profit. So do not be that guy. Research, study, and make sure you're buying something that is worth it. From the future value formula, use compound interest in your favor. The sooner you start investing, the more money you have in the future, the less you have to save every year or every month, and the less risk you have to take. You can reach your financial goal just by taking regular risk investments. You don't need to go all in and put your money at risk because you're desperate for something, and because you have a plan, you have a long-term plan, and you know how much you need to save, you know how long you're going to wait for the future amount, and you can more or less estimate how much risk you have to take. Do not take unnecessary risk, guys. Finally, when you are ready to start investing, when you are ready to take market risk, when you are ready to take financial risk, and you are in go for it mode, before buying any investment, try to stack as many odds as you can in your favor. What does this mean? For example, you're buying stock. So you saw this company on TV advertising new products, and that got you hooked. You believe that the companies will do great in the future and you want to be part of it. So you're going to buy some of the company's shares. But don't base your decision only on what you think and only on the company's commercial. You should see the past as well. How has this company been doing the previous 5 to 10 years? What are the company's earnings? How much debt does this company have? How much dividends have they been paying? So what you are looking for here is a fundamental analysis of the company's financial condition. Also, when you start trading in the financial markets, you might be willing to use past trends, moving averages, and all those analytical tools to find out the best time at which price should you buy your stock. A lot of people say that fundamental analysis is more important, and a lot of people say that chart analysis is more important. But what we should really do is to try to stack all odds on our favor. Do both. Do fundamental analysis and do all the price and chart analysis, so you can gather as much information as you can to evaluate the investment and see if it's a good choice for you or not. And that's it, guys. This concludes our Dealing with Risk series. As you could see, in this last video, we start using some more financial lingo, right? Financial vocabulary. We started to talk a little bit more about all those investing and portfolio and all other terms that have to do with investments. And we even show that future value formula. It might have gone too fast for some people, and I want you to take a time and try to digest all this information slowly. Remember that you can always leave your questions in the comment section or email me, and I'll get back to you as soon as I can. And don't rush, guys. Try to take in the information and learn at your own pace. Thank you very much for watching, guys. See you later. Bye bye.